Thursday, November 4th, 2021, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the Federal Reserve and specifically Jay Powell, the chairman of the Fed, his press conference yesterday and what he said and how, in my opinion, not just the Federal Reserve, but all central banks are trapped. They can't stop inflating. Yes, they're the ones with government that inflate. What we see as rising prices is the consequence of inflation. And they've been doing it in an extreme fashion since the '08 crisis, since the collapse of the banking system that had to be salvaged. Well, yes, there would have been a complete collapse of the banking system. They salvaged it by throwing everything at it. The ECB salvaged major countries in Europe in 2012 by throwing everything at it. Last year, they threw everything at it. Yes, you will see that Jay Powell, if you want to, because you can go to the Federal Reserve's YouTube channel, and they've got the whole press conference on it. They have the introductory part, and I recommend you watch the introductory part for his statements, and also the Q&A part. That's the most fun one. So I wasn't going to watch the press conference. I watched it afterwards because it's painful watching someone basically twist the truth so much as a central banker. And that's why today I've got my End of Fed mug. It's one of the most popular in the Teespring store. You can see mine is worn out. It's quite old. So I've got others as well, like Bury the BOE, which is the End of Fed equivalent of End the Bank of England. I've got End the ECB with Christine Lagarde behind bars. So for the major central banks, maybe I'll think about doing something for the Bank of Japan or the RBA as well for my Aussie viewers. But anyway, back to business. So what did the Fed actually do? Are they really hawkish? Well, here's Tavi Costa, what Tavi Costa said. And I've had Tavi Costa twice on my channel. He's from Crest Capital. He's a macro analyst. He said inflation versus financial conditions. So financial conditions are really how easy money is for the financial markets. And as I've said before, inflation is the creation of credit and currency out of thin air. And that's what the Fed and the governments have been doing in spades since 2008-9. And especially they accelerated it last year. What we're seeing in terms of what is called inflation is actually the consequence of inflation. The rising CPI above 5%, rising PPI in Germany, all at 30-year highs. Those are the consequences of inflation. So how come we didn't see prior to this year as much rising prices like the CPI and PPI? Well, it's because a lot of the inflation went into the financial assets, into real estate, stock market, bond market. But now the stock market and bond market have become so inflated that some big investors think it's wise to allocate some of their money into tangible assets, into real goods. The Fed's favorite measure of inflation is at a 30-year high. And these guys are still doing 400 billion of QE with no absolute rush for hiking rates from zero. In their defense, policymakers are completely trapped. Hard not to be an inflationista these days. So what's this 400 billion? Well, that's the amount of QE that they will still be doing despite of the 15 billion tapering a month. Right now they're doing 120 billion a month. So they're going to decrease every month by 15 billion, and they should be at zero by in about 8 months. But Mr. Powell uses the excuse that unemployment is still, the labor market situation is still not back to where it should be. No one in that Q&A asked about the stock market and the bond market being a bubble. Jay Powell never mentioned it. So all he said was the reason we're not raising rates despite inflation or CPI and PCE going through the 2% target, and even though we see the danger of it continuing, he said it's because he wants to see the labor market situation improve. But if you look at U.S. unemployment rate here, right now it's at 4.8%, the unemployment rate. It's forecast to come out tomorrow at 4.7. So you look historically, going back 50 years, it's more towards the bottom in terms of unemployment. I mean, if it was at 8 or 10%, maybe I would understand it. But you never heard yesterday Jay Powell saying, well, the reason we're keeping rates low is to keep the stock market souped up. That's what he should have said. It's to keep his friends on Wall Street and the City of London whole. It's to keep his portfolio whole. Never mentioned the stock market. And it's also to keep the house of cards going, because the US and the whole Western European economies, even Australia, of course, and New Zealand, they're all based on easy money and credit. So if they start raising rates, it's the end. And he also blamed a lot, this crisis we've had, this health crisis. He blamed everything and everyone but the Federal Reserve for the situation we're in. He even only blamed the government for fiscal policy. So he and no one said, well, Mr. Powell, the only reason the government has been able to borrow so much is because you are doing so much QE and buying their debt. Yeah, albeit indirectly, but it might as well be directly, right? Monetizing debt. So he never mentioned that. So I think Tavi Costa is completely right. and I've seen eye to eye with him for the last couple of years since I've followed him. And I've seen it as this even before that, because I knew back in 08, 09 that the central banks would never be able to exit this inflationist policy. They're trapped. And that's why you need to be aware of that. What you do to protect yourself is another question. I can tell you what I've been doing, being as much as possible outside the system, having zero debt if possible, having hard assets. And it can be any hard asset, depends on the individual. But liquidity-wise, I want to have real money, physical gold and silver. Yes, I do have mining shares. And today I'll go over a little bit what I have in my portfolio, because I've added on some uranium companies. Someone asked me the other day, can you tell us what you've got? And this is not advice. This is just showing what I've got. Yes, it's been a tough time for precious metals since last year. But I think gold, silver, and the miners, so bullion and the miners, are being given away for free almost, so to speak. I think it's a steal right now, and that's the way for you to protect yourself against the inflationistas, right, at the Federal Reserve. So I personally think Jay Powell and all other central banks, and I've noticed that the ECB is backtracking a little bit. They're saying they're not going to raise rates next year. They're going to keep doing their QE today, of course, we got the Bank of England. Some people think they might raise rates. I don't think the expectation is for them to raise rates. Let's quickly have a look here what investing.com is saying about the BOE. Yeah, the expectation is that rates will stay at 0.1, but there has been talk that they're going to raise rates in November. So yes, I think the central bankers are not just trapped, they're skating on thin ice. And why do I say that? Well, because you can't keep inflating the currency with no consequence. And the consequence, of course, is the debasement of the currency. It's strange that none of the people asking the questions, the reporters, ever talked about the currency and the fact that the Fed is debasing the currency. It's a term that's not used anymore except in circles like mine, in the alternative economic space. It seems like, yes, it's okay to have 5% rising prices for 2-3 years, as long as they go back to 2. But if you add up and compound all those 5%, we would have to go to -5 for 2 years to make it so the currency doesn't get debased. And do you think that's going to happen? Of course not. If the Fed wants to keep rates at 0 when we have prices rising at 5, do you really think they're going to try to keep prices rising at negative? No way, because that would mean a normal monetary policy, normal rates. It could eventually happen, but it won't be because of central bank policy, but it will be because of the market reacting. And I think that's the thin ice right now. And I think commodities and precious metals are going to be the canary in the coal mine. They're going to say these currencies are gone. And what about the shortages in the supply chain? Well, that's going to stay disrupted. And they're going to use that, of course, as an excuse. They're going to blame everyone and everything but themselves. So with that, let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. Yes, I did say I'm going to look at the miners and the energy companies now that I have, and I will after we go through the normal market rundown here. So yeah, gold and silver were hit hard prior to the FOMC yesterday. Was it manipulation? Probably a bit. Probably speculators. That's the problem when you have a futures market, and it's one of the reasons they created the gold futures contract on December 31st, 1974, when they legalized gold again after over 30 years of banning it. They wanted the public to be involved in speculating in paper, not buying the real thing. So yeah, there's a lot of people who say, oh, I have gold, but they don't. They're just speculating in the price, and they were probably getting out before the statement. They thought the Fed might be really hawkish. Yes, there's probably a little bit of bullion bank nudging through selling, right? Selling short, not really selling gold, just selling paper. And then the FOMC came out and gold is rebounded about $20 since that low. Yes, we're not near the highs of yesterday, which was around $17.95, but we're at $17.75 right now, up $5. Range has been $17.62 to $17.78.50. As I said, if you can get gold at that price, you'll be very lucky. And I think it's being given away right now, both gold and silver. That's my opinion. And I'm not telling you to go out there and buy it. It's up to you to do it. What about silver? Silver got down to exactly $23 yesterday prior to the FOMC. Right now we're at $23.58, up 7. Range has been $23.75 to $23.42. And I noticed that yesterday silver led the way back up after the drubbing they got What about the stock market? That's the main indicator, really, that the Fed keeps an eye on. They say it's full employment and stable prices, which is a rubbish excuse, really. They're not. Their main concern is the stock market and keeping bond prices high. So anyway, the Dow is up 5 points this morning, so not much to write home about. The NASDAQ 100 futures up 76, up 0.5%. S&P 500 is up 7 points. Yeah, the stock market, yeah, you can't fight the Fed. They're going to keep inflating. As Tavi said, they haven't stopped doing QE. And I think Jay Powell also said something about the launch pad, which is the launch pad for interest rates. He said, we didn't even talk about that. We don't even talk about that right now. So that's another way of saying we're not even thinking of raising interest rates, right? To the currencies, sterling is down a third this morning at 136.35. The euro is down 0.5% at 115.50. The dollar is up 0.1% at 114.11. And the dollar is unchanged versus the yuan at 639.50. Aussie dollar is down 0.25%, 74.29. The dollar is up 0.1 versus the Canadian dollar, 124.04. And the Kiwi dollar is down about 0.4% at 71.32. Commodities, crude oil, WTI is up a third at 80.35. High-grade copper is up 0.5% at 432.54. Natural gas is unchanged at 5.70. So I guess if you've been patient enough to keep listening to me, I'm going to go through the mining stocks and energy company stocks that I have. The other thing I would say, though, don't just listen to me and buy the ones that I have. What I did years ago to try to build a portfolio of miners once was not to buy the ETFs, but to go through prospectus of gold mining funds like Sprott, and at the time there was one called Tocqueville Funds, and they publish the information about their holdings. It might not be up to the day that you look at it, but it's pretty recent. And get an idea of the companies they own and try to look at them and then choose some. Sometimes, choose one that's a big company, big market cap. Choose some that are mid cap, lower cap. Do your own kind of analysis, and you might only like the big companies. It doesn't matter, whatever suits you. This is no particular order of preference. I'm just going to tell you what I've got. So I've got First Majestic Silver Corp. I've got Pan American Silver, and I'm not going to give you the ticker because sometimes I don't know the ticker. Some people only talk in terms of ticker, but I like to know the name of the company. The other one is Hecla Mining. I've got Barrick Gold Corp. I've got Newmont Mining. Newmont Mining and Barrick Gold, they're paying a pretty decent dividend. I think Newmont Mining is almost 4% dividend. And I've got Gold Fields Limited as well. So those are my silver and gold miners. And recently I ventured into uranium mining. So I've got Cameco Corp and I've got Uranium Energy Corp. So there you go. I think those are going to do well. I think the commodities are just starting on a massive secular bull market. Of course, the flip side of that is that everything's going to get more expensive for the general public. And you might be able to benefit by having some of your savings in the miners, in the energy companies. There are other commodity-based companies, but I haven't looked into them. But maybe you can look into it, or maybe write down in the comment section what you've got, other parts of the commodity sphere. I might look into it, and I might dip my foot into the water in other sectors of commodities. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.